Hi, and welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again this week for last week today, where we talk about everything in the markets going on, what's coming up. There's a bunch of things going on today, obviously, if you've been following the news. So let's jump into things. As always, keep in mind that everything that we cover on here is for information purposes only, educational purposes. Do your own due diligence or reach out to a professional. You can always reach us at mikeonmoney.com. We're happy to answer any of your questions, talk about any strategies or techniques that you might want to apply in your portfolio, or other ones that might apply specifically to your situation. So always go there and let us know your thoughts, let us know your questions, and we're happy to help out, especially if you're listening to this on the recordings on YouTube or the podcast. If you're listening in, just go to mikeonmoney.com and we can help out in any way that you need. With that, we always do a quick COVID update. Not a lot to talk, or not a lot that I'm going to talk about on the COVID update, really from last week. Obviously, things are progressing on the reopenings and lifting of the restrictions, which is great. What does that mean? Who knows? The schools are starting to lift some mask mandates. In BC, they're starting to give out the rapid test to kids to take home for the students and their. But all in all, pretty much what we're seeing around the world is more and more, restrictions and testing being lifted. Travel for Canada, of course, you don't need the PCR test as of March 1st. Do remember it's March 1st, because I've actually heard some people trying to travel and getting caught that the rule does not apply to March 1st. But March 1st, you only need the rapid test to come back to Canada, the same as if you're traveling to the US. So just, again, my only comments on the updates is stay on top of what the rules are if you are traveling. Excuse me, especially depending on where you're going. The rules can be different in many different parts of the world, and they can change on a dime. So try to stay on top of them. So with that, let's move into what's going on in the economy. We are looking at the home price index for December coming out here shortly. To see those U.S. numbers come out. U.S. Conference Board is getting together to look at the consumer confidence for February to see where that's lying. Home Depot's going to be reporting their results. So Lowe's, both the big U.S. home renovations, I guess, or home supplies, home building supplies shops are reporting this week. So we'll keep an eye on that. Stock futures fell this morning. They were actually looking pretty good yesterday. I know the markets in North America were closed. They were looking fairly well yesterday, but of course, bit of reversal on that with Vladimir Putin coming out and ordering troops into breakaway areas of the Ukraine, declaring that they're independent from Ukraine and that they can go in there. Obviously brings on fear of war or conflicts. And with that, oil prices jump. The actual oil stocks are off a little bit this morning, but the oil price is up. So a little disconnect, but we'll probably see that come back into line again. Markets are selling off a bit this morning, basically with Putin's order to kind of maintain the peace, going as peacekeepers, but sending in troops into an area where there's no conflict, of course, is not necessarily keeping the peace. So I will say, I know just before I was getting set up for today, because I am in a temporary spot, as you know, we're doing renovations in the office, that Biden was going to give an update as well. So that is probably happening live right now, or just finishing up live, and we'll have an update for you next week, or you'll probably see it later today. Other things going on in the market, Tesla software allows for quick fixes. So if you've been following Tesla, they've had a couple of recalls, a couple of issues around some of their safety features in the vehicle, specifically braking, some a little bit with the self-drive, and also some concerns. You can turn your horn to make different noises, sometimes rude noises, and a lot of complaints. And anyway, Tesla has the ability to do updates remotely on the car. So they send out a software fix, just like you would get an update on your phone or your computer. It gets sent into the Tesla vehicle. The update happens and done. You don't have to take your car in. They don't have to, pay technicians to work on the vehicles one by one. So a lot of car manufacturers are really envious of that. And more are coming out with features like that. Basically, the cars can self-diagnose themselves and fix themselves in a lot of cases. But a little dystopian that we're heading down that route. And that's kind of the real reason when we look at vehicles today and why we're seeing such a shortage on the new vehicle market, is because of the amount of computing hardware that's in there, the amount of microchips that are in those vehicles. And that's where, the big bottleneck is to get more new vehicles off the assembly line these days. So more and more we're seeing that, not just from Tesla, a lot of the, especially the more luxury brands, but, give it a few years and almost every vehicle is going to go that route. Because if you think about it, the more we move to EV or the electric vehicles, the less and less you have to go in for maintenance, because electric vehicles don't have, the necessarily oil changes or air filters or, transmission, all these different things, fan belts, right? There's no radiators. Their maintenance is much, much lower, which means you're going to take your vehicle in less and less. So something we'll keep watching. The UN pact may restrict plastic production, which big oil is pushing against. So if you're not aware, oil is a big component in making plastics, or oil byproducts are. So they're pushing back, but the UN is really pushing forward the United Nations members are set to meet next month in Nairobi to draft up a blueprint of how we can manufacture less single-use plastics, which really, when we look at plastics, and if you dive into the recycling of them and how much we use them and reliance on them, really that's the only way to reduce, plastic waste around the world, because what you throw into your recycle bin isn't necessarily getting recycled. I won't get into stats because I'm not a specialist in that area, but I do, if you are interested in it, go do some research. A lot of what you put into that recycle bin is not recycled or is not even recyclable. It all has to do with contaminations, different types of plastics can't be mixed with others, et cetera, et cetera, et cetera. So the only real way to reduce plastic waste is to reduce the manufacturing of it or our use of it. So it'll be interesting to see what they come up with out of that. Obviously, big oil is going to be putting pressure to delay that as much as possible, but we'll have to see. Other news out there, the U.S. execs and home sales are set to accelerate. As I mentioned, we're looking for those numbers. But this is pushing out the first-time home buyers, which is not a big surprise because depending on where you live, especially Vancouver or even Toronto, the prices have gotten to a point where how are first-time buyers getting into the market, especially without any family or financial help to get into the markets. The valuations have soared in the last almost 20 years, but certainly in the last few years at a crazy rate. So as we see that continues, more and more areas are being affected by those kinds of valuations. The Federal Reserve is adopting a strict trade-in rules, or looking to adopt a strict trade-in rules after some ethical scandals. So the Federal Reserve had some trading scandals last year around some senior officials trading kind of ahead of their discussions or the release of the discussions. But this is a bigger issue, not just in the U.S. government, but in any government. I mean, we've talked over the last year a lot about the Senate and Congress, trading in their own accounts ahead of their meetings, whether it's Nancy Pelosi or, the Republicans, they're allowed to trade or, in Pelosi, I think, was the most followed, although she's certainly not the only or the biggest perpetrator of this. Her husband was doing trades in his name, but for both their benefits and making lots of money. Is that insider trading? Is it insider information? We saw some Republicans get into a lot of hot water at the beginning of COVID in 2020, who were selling out their stock, knowing that the shutdowns were coming before they were made public. All these different things. So should political officials, especially in the United States, because some countries, it's different depending on the office you hold in Canada, you have to put your investments into a blind trust when you hold an office, which would make you an insider of government regulatory or legislative information. So all your money has to go into a blind trust, which means it can be invested based on broad parameters, but you can't make decisions based yourself. You have to assign that to someone else to make those decisions for you without the information you hold. So we'll have to see if any of these adoptions make it different, or if they take it further in the United States around those rules. OPEC's out there trying to, OPEC Plus, I should say, is out there trying to bring Iran into the supply deal. Of course, Iran moved out of the OPEC Plus when the Iran nuclear deal fell through, or that the US pulled out of it. Of course, now that's trying to be revived by the United States and Iran since the administration change. OPEC Plus is now trying to bring them into the deal, really just to avoid bidding more on the oil supply out there to potentially erode the strength in the oil price right now. Feds are hoping for the low inflation and lots of jobs, strategy. We've talked about this, for a year now, that, the beginning or end of 2020, beginning of 2021, the US Fed and the Bank of Canada, big goal was to not raise rates until 2023 and to bring back strong jobs. So keep inflation in check and keep, the job market really strong. Obviously, that's a tough job. We've talked about it. I've mentioned it many times, that's big, tall order to deliver on. And of course, now we're looking at a rate hike in coming days, well ahead of the 2023 original target, because inflation got so high. Job market is really strong, down, the numbers have fallen dramatically. But as we've seen in past, when the inflation started to increase and the job market got really, really tight, it became a quick reversal where, all of a sudden we head, closer to a recession type of scenario as opposed to a soft landing, and the job market, takes off, or the unemployment rates take off again really, really, really quickly. So they're still trying to juggle this, but we're going to have to see how the coming rate hikes affects things. Pickle lane, right? So with all that, down years are rare for both bonds and stock markets. I've talked about this quite a bit before, that, I've got videos out there called 60-40 or balance investing, the buy and hold strategies, modern portfolio theory. These all refer to kind of that I'm going to diversify my portfolio in part bonds, part stocks, because when stocks go down, bonds go up, and when bonds go down, stocks go up. But when we get into certain periods, and they're becoming more and more frequent in the last couple of decades, we have both of them moving at the same time. And currently, with kind of this hottest inflation market in 40 years, has unnerved equities and bonds equally, and we could see both of them going into the red in 2022. In general, in the broad markets, again, not necessarily in portfolios. We've talked about different positions in portfolios, but that kind of 50-50 split or 60-40, which is the most common out there, isn't always the safe haven. And we've seen it in multiple markets. I mean, 2020, when everything closed, we saw that. And obviously 2008, between 2007 and 2009, we saw that. We saw it in 2011 during the Greek crisis, financial crisis. So just be aware, we're headed into another one, or potentially headed into another one of these positive correlations between bonds and stocks, who are naturally not positively or not really positively correlated. So you might not find bonds being the safe haven you might want them to be in 2022. So with that, let's take a look at what's coming up this week. Moderna is going to be reporting. So this will be an interesting one, actually. Moderna has been quietly in the background, excuse me, over the last, almost 2 quarters, still ramping up production and having great numbers with their vaccine production. They're still one of the top producers out there. But we're going to have to take a really close look at what the forecast is coming up for this year, and also the capital spending plan. Because we've seen with a lot of these companies that have had really good earnings, we've seen costs ramp up dramatically. So we'll keep an eye on that. We've seen the economy in the U.S. kind of come out with it's likely to grow almost 7% in the fourth quarter. So we'll keep with that kind of record estimate coming out. We're going to have to keep a really close look at what the expectations for this year are, because we can't maintain that. Obviously, that's driving a lot of inflation, and we're going to keep an eye on the expenditure price index, which is also scheduled to come out this Friday. As I mentioned, Lowe's and Home Depot are looking to report, most likely report a rise in fourth quarter sales based on holiday demand and people continuing to do home improvement projects. But as with everything, really keeping a close eye on costs that they're going to be putting out, and really also potential cooling. How long can this housing spend continue without some sort of slowdown? Consumers are going back to work, consumers going back to travel. That means less and less budgets for those renovations. And I know myself, I'm kind of done with the home renovations since the pandemic. I did do a few. I was guilty to be part of the herd. But I'm slowing down on those now. DuPont is looking to shed mobility and materials unit for about $11 billion on a Calamese deal. DuPont is going to sell off those business units just to focus more on its higher margin operations. Probably a good idea for their balance sheet these days. GI warns of profit hit in the first half from supply and labor issues. So that continues across the spectrum. Doesn't matter what business you're in these days. Trying to get labor and obviously the supply chain issues out there, continue to cause problems for companies. I know I'm personally in a battle with Federal Express. You did an overnight shipment that's 7 days not there, and all we get from them is we don't have anyone to go actually deliver it. So cautious of any service expectations you have out there. Certainly not blaming the individuals, it's not their fault, but companies are really struggling to meet their supply and labor demands that they need to meet their clients' expectations out there. As I mentioned, cool and home improvement demand may have pressure on Home Depot for 2022. So we'll look at those numbers. Deere aims for bigger profits this year as price hikes power their best earnings beat ever. So Deere announced their profits, beating all the estimates for the quarterly earnings. And they're expecting a big margin boost from a price hike that they put into place, basically due to supply chain driven. But demand remains solid for them. Obviously, agriculture has not slowed down, is not likely to slow down, and people will pay those higher costs. That's part of the inflationary impact. JP Morgan sees higher net interest income and targets, and still sees higher targets for its coming year. They hit net interest income grew to 53 billion, expected to grow to 53 billion in 2022, up 3 billion from prior forecasts. So the financial firms continue to rake in the money, and higher interest just means higher spreads for them. On the US dollar front, with everything that's going on in the Ukraine, obviously that's driving up the US dollar. It's the safe haven currency. We're likely to see that continue unless there's some sort of resolution, which does not look like we're going to have anything soon. Obviously, there's talks of Putin meeting with the US and the UN NATO in France. That Macron is trying to broker that meeting, which they've all agreed upon in principle. But right after agreeing to that, that's when when Putin kind of announced the free territories and moved peacekeeping troops into eastern part of Ukraine. So a lot of sanctions are coming down. Germany's put sanctions this morning on the gas pipeline with Russia. UK is moving to do sanctions. Most of the NATO countries are moving to put sanctions on Russia. I think Turkey's the only holdout so far, but we'll keep a close eye on what those sanctions are and what they mean. I know the U.S., I believe, has put sanctions on 3 big Russian banks and individuals who are close to Putin and involved in financial dealings in the United States. So we'll see more and more of these things as continue to play out. On the bond front, we did see the 10-year note drop a bit. Remember last week it was over 2%, down to 1.9. That's pretty much just the market saying, we expect the interest rate, we're fine with it. It's already priced in. So that first interest rate hike, even it's an aggressive 0.5%, the market's kind of, yeah, we're fine with it. So I wouldn't expect too much turmoil when we hear the interest rate hike from that. But we'll have to see what the messaging for the next hike or when the next hike might happen is really what's going to be the key to the next meeting from the U.S. Fed. And after record inflows, bond funds have sharply reversed their overwhelming outflows that they've had year to date. As I mentioned earlier, bonds may be in for a tough year. So be very strategic with bonds. If you're using an ETF or you're using bonds, I wouldn't go the passive route this year. I would definitely look at tactical. You definitely want to have money being shifted around. You may want to use hedging in the portfolio, and I don't mean aggressive leveraging. Bond managers can apply different hedging strategies to lock in spreads, just reduce risk in the portfolio, and also try to enhance returns. So if you're looking for some recommendations on that front, reach out to me. Happy to talk to you, depending on what you're looking at using. There's several really good ones out there that we use in our portfolios, and also that I'm following very closely that can work for you. I don't highly recommend you look at doing your own hedging on fixed income. It's really a market that not just from have professional hands on it, but it is such a tight market. It's not like the stock market when it comes to trading capabilities and volumes. You're really well served in a really well-run tactical bond ETF over doing it kind of on your own, or even a closed-end fund, which is similar to an ETF in that it trades on the exchange and have very, very, very low fees for those services. So reach out to us, as I mentioned, on mycomoney.com if you want to have more fixed income in your portfolio, want to look at different positionings for 2022, because it is going to be a tough year out there for the fixed income side. As we've already talked about, very likely a volatile year in the portfolios. We're already up to, or we brought the portfolios up to, I think we're at 27% cash as of a couple of weeks ago, as we raised money into the rally before we started this downward trend. Again, not trying to market time any positions. We've just trimmed out positions that had good runs. We've just reduced our exposures to those positions and are ready to deploy that cash if we see kind of valuation stabilize. Obviously, until anything happens in the Ukraine, there's no predicting what's going to happen in the Ukraine. So, it's certainly not a market time in play. We're definitely waiting for some clarity on where things are headed before we deploy that cash or the bulk of that cash. And that's not market timing. That's simply, as I've always stated, managing risk is just, if not more important than managing your returns. If the market falls 20% and you fall 20%, and the market bounces back up 20% and you bounce up 20%, you're not at break even yet, right? It's not how math works, because you have less capital working for you at the bottom. Where if the market falls 20% and you only fall 3 or 4, and the market can come back up 20, and if you only catch 10 or 15 of that, you're going to be much better off. And that's always our strategy. It's not market timing. We're simply trying to manage risk. We risked off a little bit in the portfolios, in the good news markets, and we will risk back on again when we see clarity that we're through at least the worst of the bad news markets. And we're going to see a lot of that this year. If it's not Ukraine, as I mentioned, it's going to be messaging on the interest rate, the inflation rates, and we can really protect the portfolios or manage the risk a bit. You never protect it completely. Well, you can if you get out of the market, but if you're trying to optimize your risk return, we want to stay on top of those numbers and make sure that we get through it as unscathed as possible, and taking advantage of the values that the volatility brings to investors, to take advantage of those dips in the markets. So with that, commodities dimension, oil rose again. I think I saw this morning we were just shy of the $93 mark US. Definitely looking at $100 a barrel potentially, depending on what happens or goes on in Ukraine. And as I mentioned earlier with Iran, but that could push us, kind of over that hump. We'll keep a close eye on that. We're already seeing gas futures jump 8%. UK rose almost 60%. UK gas futures, and the US benchmark gas contracts gained 2.6%. So, pretty much across the board when we talk about energy, we were going into a supply crunch, and now we have this whole Ukraine situation happening. It's just lending more and more to that push on the energy prices. But again, if you've got those energy positions like we did trim them a little bit, and we will continue to trim on opportunity, not get out. And if we see pullbacks, we will jump in again a little bit more. But that being said, that's true of the whole portfolio. So with that, thanks very much for joining us this week. That was our update. As always, go to mycomoney.com for any of your ideas, comments, feedbacks, or questions. Love to hear from you. Otherwise, I'll see you in 2 weeks. I am off next week. I'm traveling, getting out of our temporary hold here. I need a break during this renovation. Hopefully when I come back, we'll be close to be done the renovation. So it'll be 2 weeks away. It'll be away 1 week. So we'll follow up in early March and have some updates for you. But in the meantime, if you're looking for updates, as always, reach out to us. We're happy to answer all your questions and help you out wherever we can. Thanks, everyone. Take care.